Ladies and gentlemen, good morning and happy Easter. As always, we start our review of the week that was with the yield curve in the United States, which we firmly believe drives most other asset prices over the short term. And we've had our surprise breakdown in yields, least of all in the short end and most of all in the long end. But now, as we have believed for quite some time and have we've been saying for quite some time, we believe we will retest this 0.382 retracement level in the 5-year, which is at 1.66%, and that should coincide with a test of this 200-day moving average, which is fast approaching that price level. In the 10-year, much the same thing is in evidence. The 10-year has broken the triangle it was in far more obviously than the 5-year. That's because the yield curve keeps on flattening. It has been flattening for weeks, and as we said, the safest position has been to have a flattening yield curve position. The 0.382 retracement comes at 213, while the moving average is 200-day moving average is just over 2%. So we are quite convinced that we will get a test of between 213 and 210, let's say, and that should be a good place to initiate swing shorts in contracts and longs in yield. We At the moment, we don't see that is going to be exceeded very easily. There will be a huge battle between bulls and bears at that level unless something enormous has changed. And for the time being, as we shall see from the early spreads, that we don't believe is happening. Fixed income markets in the EU had a quieter week, but still were finished quite strong. The yields are falling. As you can see, these moving averages still haven't turned. This is the 2-year note, the SHATs. It is still in a yield downtrend. No point in speculating against it until we get to these levels, the -93, -95 levels outside of the Bollinger Bands. The 5-year note as well, still with a sort of flattish weakening trend in yields. Nothing to be done until we get to -60. And in the Bund, well, that is the one which is the least bullish in price and bearish in yield, and that is simply because the yield curve even there continues to steepen. We have the French elections coming up next week, at the end of next week, and then second round in May. The market could well be skittish, and the timing for to go short the contracts and long the yields will probably be sometimes between the first and second round, when people get really panicky about what the French are going to do. We are convinced that the French will actually do nothing. They will vote in the conservative candidate, and then you will have a marked difference in trend between the EU and the US yields. The euro against the dollar has done very little, simply because the interest rate differentials are still favoring the dollar, even though we think that will stop in the next week or two. There is a distinct possibility that the euro falls and makes new lows around the 105.20 area, but we think that will hold it for the next leg up towards the 108 area. once the French elections are out of the way. The market is very skittish about these French elections. There is a very good reasoned argument to be made why one should be skittish about them, because if we have a Le Pen outcome, the euro could go much lower, below parity. On the other hand, we think the odds of that happening are very slight. Unfortunately, this pattern in the euro is affecting the dollar, the DX index, which should have broken down with the 5-year note, but has not. And now we are short of the DX, but we are quite resigned to being stopped. We have a stop right above the market, very tight, and we wanted it to be tight because we understand that the market is skittish about the French election. We think that there is a very good possibility that we go and spike this 0130, 0150 level in the DX before we collapse back down. We are now quite convinced that the trend in DX, once the market settles, is going to be down. The administration wants it. It suits everyone. It is the only thing that's really going to prop up the American stock market. So we are convinced that that will happen at some stage. The only question is from which level. We certainly will be sellers around the 102 area, 101.55 to 102 area. And if it breaks the 102.30 level, then we will get out of the market and revisit at a later stage. The one market which makes us convinced that DX at some stage will absolutely collapse is actually gold. As you can see, it is beginning to break this downtrend line from the highs. We didn't expect it. Okay, we do have this problem with North Korea, and gold is always very sensitive to those geopolitical problems, and we could come in on Monday and gold could be a lot lower because everything has been resolved. But yet it is this strength over the past few weeks, when the market just could not go down below 1,200, which makes us convinced that this is actually showing the way for DX in the future. Once the French elections are out of the way, once North Korea is out of the way, once things return to normal in terms of volatility, we would not be surprised if gold actually failed to break down significantly and then was ready for the next leg up. That will be the indicator that DX is ready to break down, as the administration wants it to. So far we have seen that gold is at a crossroads, that the DX is at a crossroads, that interest rates are behaving very oddly, certainly not as most people expected them to behave. And now we go to our spreads and our early warnings. This is a chart of XLF with the 13-week T-bill minus the 5-year note. So basically a chart of bank profitability overlaid onto XLF. This is the reason why last week we just could not be bullish of equities at any level, apart from a tiny technical bounce. The market continued to break down, and it is now below the levels it was in this spread before the election, when XLF made this huge jump. There is an argument to be made that XLF should be higher than these levels, simply because of the repeal of Frank Dodd and lower reporting requirements and so on. Yes, that is true, but bank profitability is still what XLF is all about. We are quite convinced that XLF will break this level around the 2285, which will signify a return to around 2170 to 2200. That would be a reasonable level to expect XLF to break down towards. So since we actually are expecting a strong break in XLF down in the region of 3%, it is very hard to see how that can happen without the overall in the market indices like SPY coming down with it. All our early warning signs are beginning to flash red. This is a chart of HYG, which is junk against TLT. As you can see, it has broken to the lowest level in 2017 and is now testing this uptrend line which has held since the beginning of last year. Should that break next week, you can expect certainly a very quick 2 to 3% move down in equities. Basically fast and sharp. The other indicators which are flashing red are, this is a chart of SPY over IEF. IEF is 7 to 10 year yields. It's broken the 200-day moving average. The 50-day moving average is now coming down and is telling us to favor favor bonds over equities. The trend line is way lower. This would also equate to at least a 2 to 3% move down in all indices. We would not be surprised if that happened very quickly. If we have a look to the ratio between SPY and TLT, which is the very long end, 20 to 30 years, same pattern, absolutely same pattern. It says favor fixed income over equities, and it looks like it is going to break down to about this kind of level, which was at the beginning of the Trump, just after the Trump rally, after the first wave of the Trump rally. So at least 2 to 3% lower in the current level of SPY. And finally, we have the high beta stocks against the index itself. It is a relationship which is certainly breaking down towards the lowest levels of the Trump rally. So we think anywhere, if it breaks down to these levels, that would certainly equate to 2 to 3% lower. In fact, we don't have a single indicator which is positive of stocks in the short term apart from this one, which is the volatility indicators, which are telling us that the market is overhedged and oversold. Well, so it is, but it can always go much lower in the short term. The market is being supported at the moment by these Bollinger Bands on the dailies, but we think that it is quite feasible for the market to trade 2280 in the very short term, in the next 4 to 5 days. That will be very good support and certainly a buying level. We think the market will be in a range between 2355 and 2280. So 2355 selling area, 2280 buying area for the next 5 to 10 days. the European stock markets have much more room to come off than SPX does at the moment. Technically speaking, we are quite sure that the DAX will test the 11,900 level next week, while we have the stocks which could easily test the 3,400 area next week. Those levels will probably be initially buys for a 1% retracement, but we think at the moment these markets are going to labor in this kind of area for a long time, and they are not long-term buys until there's a resolution to Euro USD, which we think will come way after the French elections. It is actually time to start taking clues from the Russell 2000. 1340 is going to be an absolutely huge level on a closing basis, as is the level below it, where the lowest level the market has traded all year, which is 1332. Those levels, if breached on the downside, and we do expect them to be breached on the downside, will certainly provoke a cascade down to 1290 in double quick time. Will that level be initially a buy? We think it will, but then it will all depend on the market's reaction, and will the market be able to break back above the 1331 area, and that will give us the next direction. But we certainly think that over the next few days there will be mayhem once this 1331.80 level goes, if not the level of the close, which was around 1340, or these lows here, all very close together, 1338. So any close below 1330 in the Russell is going to create a cascade down towards 1290 in double quick time. That is actually what our spread indicator shows. This is a chart of SPY over IWM, which is basically the Russell 2000. As you can see, this downtrend line has held since the absolute lows in February last year, and indicated then that the market was in a bull trend. If we now break it to the upside, we think we could definitely test this 1800 level, and that will show us there is weakness in the market, that the rally is not broad-based, that it's only confined to very few issues, and that the market could fall quite rapidly, at least 2 or 3%, as the stocks that have been going up very strongly, like Apple, have even a modest retracement. So do not bet against a very, very quick move of several percentage points in the indices to the downside. Let us now turn to the biases for next week. 5-year and 10-year notes, as we said, strong move lower in yield. We expect a test of the 0.382 retracement level and the 200 MA, which should coincide, and that should be it for the time being, unless something much stronger is going on. We certainly favor at the moment fixed income over equities. Bund and Bobble coming into French elections, it was no time to be short of them last week. The shorts still have poor risk reward, as there are no signs of a trend change, but we think that we are coming into levels where that will change. No change in commodities. apart from gold. We're still watching that. As we said last week, retracement objectives 2340, 2320, that was achieved. We do not exclude a fast move down to 2280, and the put spreads are still the safest way to trade that. XLF is the preferred short sector, and the puts in XIV are very interesting. That has happened. We can now forget about that. We think volatility now is actually not going to go up very much. In fact, we possibly could have even a move down in volatility even as the market goes down towards 2280. But Russell 2000 is the most important sector to watch. Close below 1333 will indicate that we are in a sell-off phase for all US equities. Do not underestimate that. We could have a very quick move down to the 2280 level in ES and the 1290 level in Russell. European equities, fundamentally they're still better risk reward than the US, but they probably have more room to come off in the short term, simply because technically they are there is more room to the downside before the Bollinger Band support. FEU, we're still looking for this 30-20, 30-50 area to have a fundamental long in the European equities. DX, after Trump comments, it is getting more and more dangerous to the downside. It will have false starts, but we're convinced that down is the ultimate big move from these levels, and we will watch the critical gold levels for confirmation. Finally, our spread indicators are nearly all negative. More and more indicators are showing that we are at a very important inflection point in equities and their relationship to fixed income. We could be building for a very quick 2 to 3% move down in all equities. Now is probably not the time to be limit long of equities. It is certainly a time to watch and wait to pick up much better levels around 2280. Thank you very much indeed, and have a lovely Easter.